Good day, grade 10s. We are now going to go through task 10.16 and you are required to complete 10.21 for this week 2. Right. So basically with this activity we had to work out the adjustments. We are working from a pre-adjustment trial balance and we have to work out the adjustments to get the realistic figures. So this is what your answers will look like and we're going to go through that. So remember the pre-adjustment amounts, they have been taken for you in the actual activity, literally copied and pasted over here. This is the adjustments that we have to work through and fill in, and then we either add or subtract to get the post adjustment figure, the correct figure or amount that will be taken into place. Alright, so you'll see that where there are blanks, as you can see, capital has a blank, vehicles has a blank, equipment is blank, fixed deposit is blank, there was no adjustment at trading stock, debtors control, creditors control, bank, cost of sales, salaries and wages. So those adjustments will remain the same. As you can see, there was no adjustment at capital, so it will remain 90,000. What do I do with capital? I credit capital. Vehicles is an asset, so we debit assets. There was no adjustment, so it remains the same. So where there is no adjustment, it will always remain the same in the post-adjustment trial balance. Nothing will change. However, when adjustments are taken into account, there will definitely be a change. So let's work through the adjustments. They asked us to provide for the depreciation on vehicles at 20% on cost and on equipment at 15% on the diminishing balance. So remember there are two types of depreciation methods. We have the on cost method and we have the diminishing balance method. Please refer back to previous activities if you are uncertain about your depreciation. So we have depreciation, the cost method, which of course is cost price times the percentage to give us our depreciation for the year. Alright, then we have the diminishing balance, which is cost price minus accumulated depreciation which will give us our carrying value. Carrying value is basically what the actual vehicle is worth. Once we have our carrying value, we can then multiply it by the percentage in order to get our depreciation. So the explanation I used for the cost method is the hungry lion. He's hungry, he's not going to wait for anyone, he wants to go straight in for the kill. Remember the cost price represents the lion, he goes straight in for the kill by multiplying it by the percentage to get the depreciation. However, the diminishing balance method is the patient lion. He is willing to lay down low in the grass, suss out the strong prey, So you subtract in the accumulated depreciation. The lion subtracts the strong prey, and he gets the weak prey, which is known as the carrying value. Once the lion has the target, they will then pounce on the prey, so you will go straight in for the kill. Alright, the patient and the hungry lion. So with that being said, let us work out our depreciation. So 20% on cost for our vehicles. Our vehicle amount is, the cost price is 140. So 140 times 20%, straight in for the kill, remember. $140,000 times 20%, the depreciation will be 28,000 on vehicles. Then we're going to work out our equipment immediately. The equipment was on the diminishing method at 15%. So our equipment at cost was 75,000 Rand. So I'm taking my 75,000, and remember the accumulated depreciation on equipment is 25,000. So 75,000 minus accumulated depreciation of 25,000. That should give you 50,000 Rand as your carrying value. 50,000 times 15%, and we get depreciation of 7,500. So these are the adjustments that we have just taken into account. So if you have a look at your accumulated depreciation balances for vehicles, it was 60,000 with the pre-adjustment trial balance, and our equipment was the 25,000. Remember, accumulated depreciation is a negative asset, which is why it is on the credit side. It's decreasing your asset's value. So here we go. We put it on the credit side. There's our depreciation for vehicles, the 28,000, and then the 7,500 Rand for accumulated depreciation on vehicles. Now, having taken the adjustment into account, I took the 60,000 and I added my 28,000 to get a post-adjustment amount worth 88,000 for accumulated depreciation on vehicles, and then 25,000 plus 7,500 to get the accumulated depreciation for equipment. Right. So with that being said, remember, for every debit there is a corresponding credit. So we worked out our credit, and now I have to go to my nominal account section and take depreciation, the actual expense, into account. What do I do with expenses? I debit expenses, and you will see that depreciation lies at the bottom. We added the 28,000 plus the 7,500 to give us depreciation for the year worth 35,500 Rand, and I'll put it at the post adjustment trial balance as a debit. Okay, let's move on to the next adjustment. Okay, the next adjustment says that we've paid 510 Rand on the 23rd of February 20.9 for stationery that will be delivered on the 3rd of March. Now you remember that your timeline is important, and we always work with GAR principles. And the GAR principle that we use when looking at financial statements is the matching principle. Everything that happens in my financial statement, in my financial year, should be taken into account. Everything that should not be in my financial year should be taken out. So now remember that I have purchased stationery for 510 Rand in the month of February, but that stationery will only be used in the month of March. As you can see, this is when my year ended. So March is in the next financial year. So what is that? That becomes a prepaid expense. Okay, so you'll write an account here. So here's your prepaid expense, you'll write it there, and there's a calculation. So there's my 510 Rand. That is a total amount. So going through our adjustments, we'll find that yes, we still do have another prepaid expense that was paid in our current financial year for the next financial year. So we're not closing that off as yet. Let's move on to the next adjustment. The investment, a fixed deposit, was made on the 1st of March 20.8. Interest for the last quarter has not yet been received. Alright, so again, your timeline comes into play at this stage. They're saying that the fixed deposit was made on the 1st of March 20.8. Interest for the last quarter has not yet been received. So from March, April, May, interest was paid. April, May, June, July, August, interest was paid out to us. September, October, November, it was paid to us. December, January, and February. So interest income for the last 3 months have not been received. Why do they say a quarter? Because there are 4 quarters in a year. So 1, 2, 3, 4. And of the 4 quarters, each quarter will consist of 3 months. So I'm going to go to my investment, and you'll see that the fixed deposit's interest is worth 12% per annum. Alright, so I'm going to go to that. Although, if we work out the value of that, alright, so that was the 12% interest, but you'll see if we go down nominal account section, they told us that the interest on our fixed deposit is supposed to be 4,050, and of that 4,050 we haven't been paid for 3 months. So 4,050 divided by 3, you should get a total of 1,350. Alright, so here's your interest on the fixed deposit. It was 4,050 in your pre-adjustment trial balance. I have now taken my adjustment into play, the 1,350 that was not paid out as yet. So how much in total was I supposed to receive for my interest on my fixed deposit? 5,400. Another way that you can work this out is take in your actual fixed deposit amount, 45,000, okay, times 12%, because that is for the year, 12% per annum. So let's work it out. I've done it already. I'm supposed to be receiving 5,400 Rand from that fixed investment as an income. Of the 5,400 Rand, what has been received already? The 4,050. So I can subtract 4,050, and in essence 5,450 minus 4,050, and I get 1,350, which is over here. that interest has not yet been paid, I have to take it into account because it's interest that falls in my financial period. All right, so let's move on to our next adjustment. The next adjustment is a section of the building has been let out to a tenant with effect from the 1st of August 20.8. The rent has been paid up to 30th of April. Alright, so again, timeline, very important. You can redraw your timeline as much as you want on your working out paper. So we know that our financial year ends February. Anything after February is outside our current financial year. And this person is telling us that the tenant has paid us for up to the 30th of April. So March and April, they paid us 2 months in advance. Okay, when did we start letting this building out? The 1st of August 20.8. So from August, September, October, November, December, January, February. So remember, you will always look at your pre-adjustment trial balance. Your rent income was 9,050. 9,050 is what it has on our pre-adjustment trial balance, and we will always divide it by the number of months that the tenant has paid us for. So how many months did the tenant pay us for? We have to establish what is the rent per month. So 1, 2, 3, 4, 5, 6, 7, 8, 9. The tenant has paid us for 9 months. So 9,050 divided by 9 months. $9,050 divided by 9, it is 1,005. Did I get the correct amount? That's 9,450. Sorry guys, 9,450. 9,450 divided by 9, it is 1,050. So the rent that we charge per month is 1,050. How many months have been received in advance? 2. So we're going to take 1,050 for 1 month plus another month. Okay. Which gives us rent that has been received, which is 2,100 Rand, income received in advance. Does it fall in my financial year? No, it does not, and obviously I have to take it out of the equation. So yes, we have income received in advance. Income received in advance is a liability. It is not your money as yet, and hence we will record it under the credit side. Liabilities increase on the credit side. Then you got to go down to adjust your rent income. Rent income, what do we do with incomes? We credit incomes. All right, 2,100 Rand of this money that we have received from our tenant falls in our next financial year. So we cannot account for it as an income as yet. So we will then have it reversed. We will debit it 2,100 Rand and basically subtract it from the money that we have received to work out what was the actual income that we should be receiving for our financial year. So 9,450 subtract 2,100 Rand, that should not be taken into account. We supposed to get rent from this person 7,350 Rand. Moving along to the next transaction. An advert was placed in the local newspaper during February. The advert cost 560. This amount has not yet been paid. This is expenses payable. Alright, it's in our financial year and we have not paid it. It becomes expenses payable, and expenses payable is a liability. And it is worth 560. What do I do with liabilities? I credit liabilities. There's my 560. Expenses payable is also known as accrued expenses. Okay, moving along. Oh no, we have to adjust the actual advertising. So for advertising, how much have I paid in my pre-adjustment trial balance? Our advertising is 2,310 Rand. I still have, there's the debit, it's an expense, so we debit expenses. I still haven't paid for 1 month, which was for 560. So how much in total have I paid for advertising in my financial year? 2,310 plus the 560. I supposed to be owing 2,870 bucks. According to the loan statement, the total interest payable on the loan amounts to 12,800. They have given that to us. Make the necessary adjustments, and they told us that interest is added to the loan. It's capitalized. Okay, if it was not capitalized, it would have been paid out directly into the business's bank account. But the interest, well, we would have paid it directly to the bank that loaned us money. But instead of doing that, they add it onto our loan. So the 12,800, remember, a loan is a liability, and liability falls under the balance sheet section. So we're looking for our mortgage loan, which is over here. Our mortgage loan is worth 80,000, and they adding on. Liabilities are increasing on the credit side. They capitalize the interest. How much do I owe on my mortgage loan now? 92,800. And then obviously I'll take it into account because interest on loan is an expense. I'll go to the nominal account section and I'll put down the 12,800. That is an expense for my financial year. Okay, moving along to our next transaction. The insurance premiums are paid monthly by stop order. The monthly premium is 880. Make the necessary adjustments. So stop order is a payment that is automatically taken off, and you can see that for insurance they automatically subtracted that 880. So remember, prepaid expense, I'm adding the 880 that was subtracted, and if we add that up, I should get 1,390. I will then go and account for it in the nominal account section. Insurance was worth 11,440, and I'm subtracting the 880 because it was not supposed to be, it's not my financial year. How much am I supposed to be paying for insurance? 10,560. I hope that makes sense. Now we're moving on to the next activity. You were required to complete the trading stock deficit activity 10.18. You needed to look at the information on the 28th of February 20.1. The trading stock account for Epi Stores reflected the balance of 35,120 Rand. Then you did a physical stock count at the end of the year, which revealed the value of stock on hand worth 34,540. Clearly you can see that there is a deficit that we have over here. If we work it out, in the beginning I had 35,120. I'm subtracting what I actually have on hand right now, the 34,540, and I get a total deficit of 580. I do not know where this money went to. Okay, a deficit is an expense. A trading stock deficit is an expense. what is happening to your trading stock? It decreased by 580. And remember that trading stock is an asset, and assets decrease on your credit side. So we are now going to make the necessary adjustments in our general journal. Trading stock deficit is an expense, so it will be my account debit. Trading stock is decreasing, it's an asset, and that is why we're putting it on the credit side. Our narration in our general journal is trading stock deficit as identified by physical count. Now what I have to do is go and update my stock account. Balance brought down was the 35,120. I have identified a trading stock deficit of 580. Obviously, it's an asset account. You have lost stock. Trading stock worth 580. Now you got to balance your account. Which side is the biggest side? Debit side or credit? It is your debit that is the most, the biggest amount. So I bring it down, 35,120, and I take it over 35,120. I subtract what is now missing and gone to update my account. How much is in my account now as per physical stock taken? 34,540, and I carry that down to the next month. Yes, we have identified that trading stock deficit is an expense account. What do I do with expenses? I debit expenses. I put in the necessary dates. My details will be trading stock, general journal, and 580 is the deficit. What is the effect on our accounting equation? Our assets decreased by 580 as well as owner's equity. No effect at liabilities. Now we are going to be moving on to consumable stores on hand. Let's have a read. Consumable stores consist of items such as wrapping materials, packing materials, box strings, etc. Such items are regarded as expenses at the time of the purchase. Okay? It's an expense at the time of the purchase, and it is expected to be consumed or used up during the course of the accounting period. However, in most cases, some of these items may not be fully utilized during the financial year. These unused items cannot be treated as an expense but rather as an asset. So listen carefully, grade 10s. Consumable stores are an expense, but if it is not used, it becomes consumable stores on hand. It is converted into an asset. Expense if it's used, an asset if it's unused. Okay, also the matching principle has to be applied. The expense must be matched to the correct time frame. For example, consumable stores bought during the year amounted to 4,000. At the end of the year, a physical count of consumable stores was taken, and it was discovered that there was 500 worth of consumables stores. The expense in respect of consumable stores was 4,000, but because all of it was not used, part of the expense, i.e. 500, is converted to an asset. Effect the conversion. And is reflected in the books as consumable stores on hand. A journal entry is passed to effect the conversion. Consumable stores on hand, the asset is debited, and consumable stores 500 will increase at owner's equity. So let's have a look at the activity. So we have an opening balance of consumable stores, which is an expense, 4,500. The adjustment tells us that we have not used 800. That 800 now needs to be taken out as an expense and converted into an asset. And that asset will now be known as consumable stores on hand. What we have left. Alright, what do I do with consumable stores? It's an asset that is increasing. Consumable stores on hand, so that will be my account debit. And my account credit will be consumable stores. Remember, consumable stores is as an expense, but because we have not used it, we cannot record it as an expense, and therefore it will be credited. Your details will be consumable stores on hand as per physical stock account. physical stock count. We go to our general ledger. Consumable stores is an asset. It will fall under the balance sheet section. What do I do with assets? I debit assets. Your details, consumable stores, 800. You go to your nominal account section. Remember, we had a balance brought down of 4,500 as an expense. Of that 4,500, we never made use of 800 rands worth. So instead of recording it as an expense, I'm taking it over to my credit side. Taking it over to the credit side, and I'm going to put consumable stores on hand, the 800 rand. The effect on the accounting equation, your assets has increased by 800 and owner's equity has increased by 800. I hope this makes sense. Please complete task 10.21. Thank you, grade 10s.